It's head spinning, right? It takes up a lot of my mental work each day, and sometimes even at night trying to go to sleep, just thinking about AI, right? In the sense of like winners and losers going forward. Like I think it's very clear that the AI infrastructure names are doing quite well. These are the semiconductors, the memory stocks, the hardware, SanDisk, Western
Yep.
Digital. Now, in terms of like pain points, software was one, right? The business models really came under scrutiny because software is a very high margin business. You just kind of pay, for example, for your software license. And AI really kind of did a lot of disruption, and it was more or less sold off indiscriminately. Sell now and ask questions later. And we've seen a rebound, especially with Microsoft, right? There's going to be winners and losers within that software space, but it's really created quite a bit of disruption. So I think diversifying your risk, especially too, across like the AI ecosystem and across the market, I think diversification really is key because it just takes so much mental energy to figure out where to be within these spaces, just rapidly unfolding. Be in the right position. If someone's passing you the ball, be there to catch it.
Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Today, I'm speaking with Kevin Abbott. Kevin's a senior sector research strategist at State Street Investment Management in Boston. Kevin's a former coworker of mine. We worked together in our Fidelity days. Kevin's really grown into a pretty impressive career, most recently really focusing on sector themes and particularly in technology and communication services stocks for State Street's research effort. Today in our conversation, we're going to talk about sector rotation. We're going to talk about sector ETFs for tactical versus more long-term strategies. We're going to talk about income-related sector products. We'll talk about using sectors for risk management. But we will start off talking about the whole AI ecosystem. Where are there opportunities? Where are there maybe some risks that we're not familiar with? Please enjoy this conversation with Kevin Abbott of State Street Investment Management. Kevin, awesome to see you again. How are you?
Great to see you too, Dave. I'm doing fantastic. How about yourself?
I'm good, and I'm really excited to chat with you. Obviously, there's a lot I mean, there's so much to talk about in our limited time together. But certainly with earnings season kind of really heating up in recent weeks, and certainly just this week, you get renewed focus on AI, the AI ecosystem, starting to differentiate names and themes. So I'm really excited to kind of pick a brain on a number of different things around that topic, along with other things related to sector rotation and other topics. Just to start off, I mean, one of the big themes, I guess, I'm picking up on that I'm sure you're seeing as well. We're really starting to differentiate from kind of anything with AI involved is good, and anything not AI is probably not as good. To now, we're
Hmm.
really starting to differentiate between what's working and what's not, right? And one of the issues that we've heard a lot of discussion about is this idea of the hyperscaler spending, the pace of monetization of AI. So I'd love to start with just this. I mean, what evidence would tell you with a particular name or a particular group that the spending is actually starting to generate some decent business results that we can start to bet on?
Yeah, that's the big question right there. That's the one on everyone's minds, right? And obviously kind of coming through loud and clear, not just with this current earnings season, but it's been kind of a big focus within 2026 itself. You've seen kind of a lot of earnings volatility, especially, within the tech and communication space, which you'd expect because, that's pretty much where the AI is most highly concentrated. And I'm glad you picked up that kind of differentiation, right? There's this idea, or at least there was, that AI was this kind of unified block, and it's really kind of showing that, this year especially, that, that's just not exactly the case, right? There's a lot of differentiation within. And what we've really seen, especially as the amount of capital spending's gone up by some of these companies, which really, I mean, if you just step back, it's amazing. Like 5 years ago, if you were to say that, like a company like Meta would be just this asset-heavy company spending this much money, it's just not something that you probably would have forecasted, right? So it's really something that's worth kind of stepping back and taking a look at and marveling, like, wow, there's some big stuff going on here. A lot of money being made and a lot of money being spent. So at the same time, I think for return, that's obviously kind of front and center. And there really is no like AI revenue line that we can just kind of look to and say, oh, okay, well, this is what's going on. This is the growth rate, right? We've got to kind of parse through it. And I think what you're really kind of seeing now is this kind of reliance or this kind of focus on cloud computing, taking a look at cloud computing revenue and cloud computing revenue growth. It's foundational to AI, but it also gives good insight into AI demand, right? We're able to see that growth, whether it be with Microsoft or Amazon, for example. They recently just got rewarded within this past earnings season for their cloud computing growth. It was very strong numbers, very strong growth numbers. But you're also kind of able to take a look into the backlogs too. We're seeing these, that demand that hasn't yet been realized, but it's pretty much kind of on the books, kind of looking forward, right? We're able to kind of see that, and the market's been rewarding that visibility. Really, I think that's kind of really key, right?
Mm.
Whereas if there's a little less visibility, we got to try to figure it out a little bit more. There's definitely some kind of volatility that kind of might come along, right? And I think one big thing too that's super important is that there are different time frames, right? If you take a look at the market itself, the stock market looks out about 6 to 18 months or so. That's kind of an established, I think, core look. But if you take a look at like a street analyst, for example, they're looking out, they're building a model, they're looking out 5 years or so. And what I've really noticed a lot is that a lot of the street analysts have long-term buys on these type of companies, right? Whereas, then you see like earnings, there's a lot of volatility. Stock might be down 10%, right? And so, I like to ask myself, like, what's the market saying? And also, what are analysts saying? I think that a lot of
Mm.
the returns are going to be further down the road. Makes sense, of course, with CapEx, right? The amount of money that's being spent, it will generate a return down the road. But I think you're going to kind of see this variability quite a bit too. And especially just to kind of add one other thing, with the negative free cash flow that's been in the news quite a bit too. There are a few of these big companies that have gone negative. That's not something that's unprecedented. We just had that recently with Amazon
Mm.
in 2020. They really built out a lot of their capabilities to deal with the pandemic era, spent a lot of money, went cash flow negative. It really kind of hit their operating margins and, the middle part of their income statement quite a bit. But, this is, again, where you can kind of rely on charts quite a bit too. Technicals, I like quite a bit. Amazon consolidated for a lot of that time period. It traded within a range. And then eventually, after kind of turning down 2022, um, with the rest of the market in general, as it was a bear market, it then kind of was off to the races at the beginning of 2023. So not unprecedented. This has happened before, but at the same time, the magnitude definitely, obviously, is quite larger.
We're going to come back to this combination of fundamental and technical strategies for sure, Kevin. Let's be ready for that because you've mentioned multiple time frames. You've mentioned charts with Amazon consolidating. 100% agreed with all of the above. So let's circle back on that for sure. To
Sure.
dig a little further into some of the backdrop with earnings season that we're kind of going through, you kind of hit on a couple comments related to this sort of rotation from heavy spending by cash rich hyperscalers to heavy borrowing to finance. And I know when that sort of initially came out, like this isn't just spending a bunch of cash we have. We're actually we're taking out credit cards to pay for this future growth. And all of a sudden that feels a lot less sustainable. But the market has not really dinged those companies yet. I mean, it hasn't been as much of a doomsday scenario as I think some investors probably were afraid of. Why do you think it
Right.
didn't play out as negatively as some expected when we switched sort of to the way that growth was sort of being driven or paid for?
Right. Yeah. I mean, again, these are a lot of like quality companies, like strong balance sheets, have a lot of cash on hand. That reflects too. And of course, I mean, again, I think you're kind of spot on there, Dave. It's worth kind of balancing, like, what kind of company is this, right? With also like what's the return that we're kind of looking for.
You didn't mention a key phrase I was wondering if you would bring up on your own, but I'll bring it up: circular financing, right? So some would tell you that this is this huge mirage of circular financing. These are chip makers and hyperscalers, everyone kind of exchanging revenues. And so it looks a lot better than it is. When you're digging into the nuts and bolts underneath some of these, sky high expectations, how much of an issue do you think that really is? And are you seeing particular areas of that AI ecosystem where it feels like this is a potential pain point where we're not realizing the instability of some of these revenues?
Yeah, that's a great question. So I think that definitely is. I mean, again, that's a growing concern, right? I would say that so far it's okay. Kind of digging in. The one company that I typically kind of point to that gives me a little bit of nervousness is it'd be like an Oracle, for example, right? There's
Mm.
there's just a lot more kind of debt there. It's been it's had a negative free cash flow for a much longer type of time. So that's kind of a good, I think, stock to kind of take a look at to get a good gauge of where things are and if there are kind of concerns. But that's the most extreme, I think, for those other AI hyperscalers or those like mega cap companies. There are differences, and of course, for example, we've talked about for years like the Mag Seven, right? Not all these companies are taking out huge amounts of money or spending, right? Nvidia, Apple, those are two companies that come to mind that, Apple even has like an AI strategy, but their spending really is not the same as it is as, say like a Microsoft or an Amazon. So again, not that kind of united unit, right? I mean, I think it's obviously worth being aware and, having a bellwether, for example, like in something like an Oracle is helpful to keep tabs on. But on the overall, yeah, I think is a concern, but not a overwhelming concern at this point.
It's so interesting. Those monikers like Magnificent Seven, number one, I feel like always should be put in air quotes, right? Because they're temporary, right? They're fleeting labels. But also remember, I mean, there have been different. I mean, so many periods where there's this period of time where there's like a high correlation and a very similar theme with a group of stocks, but then it
Mm.
always changes, right? I mean, it's always temporary, and that's one thing I know you and I found in our careers looking at market history through different lenses. I think as we start just to wrap up this discussion about AI before we get to some other topics, I mean, I think the challenge right now, as we mentioned, is kind of, really focusing on where the opportunities are going to be going forward. Certainly, we've had a lot of expectations for AI as a theme. It certainly seems to be, alive and well here as earnings season has generally been pretty stellar. But as you look forward, I mean, what do you look for now, or what should investors be looking for now to try to start to differentiate between which are the names that are going to come out of this in a leadership role and which are the ones that are kind of going to be left behind for some reason? Like, are there signs or are there conditions you would be looking for now to try to get ahead of that shift that's probably going to happen?
Yeah, totally. It's head spinning, right? It takes up a lot of my mental work each day, and sometimes even at night trying to go to sleep, just thinking about AI, right? Like a couple months ago was just all the pieces that went into like a data center build out, right? Like
Yeah.
there's photonics and it's just all these things that you can spend hours and hours upon, trying to figure out. And obviously there's benefit to that, right? Like you try to find those bottlenecks. I think that's always interesting. But in the sense of like winners and losers going forward, like I think it's very clear that the AI infrastructure names are doing quite well. These are the semiconductors, the memory stocks. Something along the lines of like the hardware, SanDisk, Western
Yep.
Digital, within the tech space, right? Like have very clear tailwinds, especially related to the data center build out for that strong demand for AI, right? And I think that those areas, there's also very good visibility into them too, with like earnings, for example. And earnings have been just so strong, great earnings growth within the tech space. If you see that start to maybe roll over or recede a bit, you can maybe think about, okay, what kind of happens going forward. But until that really happens, like earnings have really kind of been the lifeblood of that AI infrastructure rally. Now, in terms of like pain points, I two areas that come up are just areas that have like been disrupted quite a bit. Software was one, right? Software, the business models really in the first quarter came under scrutiny because software is a very high margin business. It was seat based, so you just kind of pay, for example, for your software license. And AI really kind of did a lot of disruption, and it was more or less sold off indiscriminately within the first quarter. And it was sell now and ask questions later. And we've seen a rebound, especially within the last this past earnings season, especially related to Microsoft. Right, there's going to be winners and losers within that software space, but it's really created quite a bit of disruption, right? And again, you need to kind of ask yourself the questions like qualitative, like are these particular businesses going to be set up to survive, right? What's their model? Are they seat based or are they usage based? Are they do they have good cybersecurity? Are they already integrated? Just kind of basic questions, but like that can help quite a bit in trying to figure out, where you want to be. And then maybe just one other thing, like just that risk of what AI spend can do. We saw IBM not too long ago pre-announce their earnings because they were bad, right? It it was not a good quarter and it caught them by surprise because their core business was under pressure because everybody else was spending, or their customers were spending money on AI hardware and they weren't spending money at IBM and their core business, right? So it's like,
Yeah.
that's a problem for them to solve. They got a good CEO. I think they probably can, but at the same time, like they're feeling pain. So I think diversifying your risk, especially too, across like the AI ecosystem and across the market, I think diversification really is key because it just takes so much mental energy to figure out where to be within these spaces. It's just rapidly unfolding that you just want to be in position. I think that's a really big takeaway. Be in the right position. If someone's passing you the ball, be there to catch it. And let's go back to that one. That
I
was
love
my
that, Kevin.
too,
You
right?
mentioned so many awesome things in there, and one phrase that I picked up particularly was how the software group, I think you're talking about, sold off indiscriminately, and I love that way of thinking about it because that's something we've seen many times, right, in previous market cycles where a group just goes out of favor, kind of everything gets sold off, and
Mhm.
then I feel like as a stock picker, there's a real opportunity to say, okay, not all of these companies are in the doghouse. Like some of these are good companies that are just getting dragged down, and I think it plays to maybe the value of recognizing the weakness in the price action, the weakness in the chart versus some of the underlying strength in the fundamentals. Because I think you and I have both seen pretty decent examples of where stocks eventually trade to their fundamental valuations, but there's some fun things that happen along the way. So I'd love to pivot the conversation next and talk about you've had experience when I think about you and your career evolution. You've spent plenty of time immersed in visualization and analyzing, investor sentiment through the lens of technical analysis, but you're also, becoming very eloquent at describing some of the fundamental stories underlying some of these companies.
Thank you.
In your experience, what's that balance? What's that right balance? And how do you think of those, in some cases, very different toolkits when you're trying to evaluate a group or evaluate a potential theme?
Yeah. So, well, using both and just kind of sitting down and thinking about it, right? I think that's always a good thing to do there, right? I think there's two big things that kind of come up um, when answering that question. The first would be using technical and fundamental as well as quant, kind of combining all three. Using all three of those lenses, I think the sum of those three are more than the sum of the three are like bigger than the whole, right? It's like it creates
Yeah.
something more than just taking those three different components and just kind of taking a look at them, right? And what I kind of mean by that is that like each one kind of informs one another. So, for
Mm,
example, if we just take the tech space, right? Semiconductors, very fundamentally strong, good visibility into the earnings, right? I feel pretty confident when I take a look at fundamentals of the understanding going on there. But also, it's informed by, for example, like the primary uptrend within semiconductors and within it, and within technology. If there's a pullback, which for example, happened this summer, and there was volatility. Having that technical knowledge and having that grounding and understanding exactly what's going on within the supply and demand dynamics in the market really is super helpful and informative, right? Especially if there's, for example, in a cycle that's been driven by earnings, for tech, when there's that lack of earnings news, right? And you're seeing Chinese models and you're seeing overseas the costs be coming down, right? People get jittery, right? And it's like having that kind of guidance and understanding where you are in the primary trend is immensely helpful for not making the wrong decisions, I think. That's super
mm,
big. And then just in technicals themselves, right? Maybe pivoting back to talking about software, we had that big sell-off. And if you've spent some time looking at the charts, for example, especially talking to money managers like yourself, Dave, right? It's like there was not a great time to get out. And
mm.
the rebound eventually happened. And when it did, it failed at the 200-day moving average earlier in the year, right? It was that first opportunity for people to kind of dump the software stocks that they didn't want. And just, again, having that kind of frame of mind and that knowledge is just something, again, that kind of helps you not get swept up perhaps in like the momentum of the moment with what's going on with these particular names or the news, right? And maybe just to add one last thing on that too, maybe that kind of quantitative piece. I always take a look at like what kind of screens will, right? Take a look at a number of different screens, and is there a narrative there that's emerging?
Mm,
If you take a look at momentum, if you take a look at valuation, if you take a look at earnings quality and sentiment, You can kind of maybe sometimes see these kind of things emerge when you tie the other two pieces, fundamental and technical. Really just paints this big picture that I think is like super helpful. So, I'm a big believer in process, but I think there's a limit to process too. You just got to kind of sometimes, just sit down and think, what's the most important thing here? But you also let the other inputs kind of speak too and figure out the best way forward.
I think that's really well said, and I often use the metaphor of a stool and think of like four legs on the stool. So for me, I
Yes.
used to talk about fundamental and technical, and I guess I kind of think of quantitative as hitting on both of those. I guess
Mhm.
the way I think of it, and then macroeconomic, and then behavioral, which is what happens between your ears. And usually tell people that if one of those, legs of the stool is not working right, you're probably still going to stay upright, but it's going to be tough. But if
It's
two of
gonna be
those are
hard.
gone, you're going to have a lot of trouble staying upright. And so we want to make sure we
Good
think about
analogy.
each of those. And I think the way you described it with fundamental, technical, and quantitative, I think is a really good way of thinking about an investment process. And what I would encourage people viewing and listening is to think about which of those three do you feel like you have pretty well covered, and which of the
Mm.
one or two you probably could spend a lot more time on, and that's where you should focus your time and effort
Totally,
to try
right. I
to
mean, it
nurture
speaks
those.
to you too, like just behavior, right? Like when you don't know or understand something, that's when you're at most at risk of having the most adverse behavior, doing
For
something that,
sure.
right?
Yeah,
So,
and the
yeah,
quote you
good
just said
advice.
was, "Don't get swept up in the momentum of the moment." I'm gonna keep that one, Kevin. I will attribute it to
Awesome.
you, but that's a keeper. I like that one a lot.
Thank you.
Let's pivot if we could, because State Street obviously known pretty widely as being sort of, a great example of sector opportunities and thinking about equities at the sector level, and just how, where we can identify some emerging strength. When you're looking at the equity markets at the sector level, what are the kind of insights you can get by assessing market conditions at the sector level as opposed to just at the index level, which is where I think a lot of people kind of oversimplistically kind of focus their time and attention.
Yeah, that's a great question, and I think it's especially relevant in the past few years, right? As the markets become more concentrated within technology, right? I think that it's kind of bounces around between 35 to 40% tech if you're in the S&P 500, right? Yeah, I mean, thinking about that, I would say what sectors kind of offer you or the big kind of sell, at least to me, I think, is it gives you great insight into leadership, um, alpha or potential alpha generation. So you're a potential for outperformance. And one of the underappreciated things, just a consistent framework. And what I
Mm,
mean by that is that the sectors don't change all that much. So the last time we had a new sector was in 2018. Communication services was created out of technology and what was then telecom. And that was really kind of the last big sector change. There's always changes within the S&P 500 on a yearly basis, but that was the last really kind of big move. And even within, right? We actually ran a study earlier this year, just kind of taking a look at the individual changes, so the constituents within the S&P 500 that change sectors. And over the last 10 years, on average, you get about seven. So that's a pretty low amount out of 500 stocks.
yeah.
If you were to talk about, say, like a factor, value or growth, momentum, whatever it might be, the average amount of change over the last 10 years within a factor is 189 constituents a year. So it's a lot more of a change, right? Like, how do you keep up with that, right? If you're
Yeah.
just the average person, I can't even keep up with that at the time. You have to take a look and sit down. But so sectors really give you a very good framework, I believe, to be able to kind of communicate, not just understand yourself, but communicate to others too. It's like you kind of speak in the same language in a certain degree. There are some differences, of course, between how they're classified, but for the most part, you can kind of see that. But I mean, you can even speak to this yourself. I think like identifying leadership and what's really kind of driving the market, what's really kind of dragging it down. We both worked at Fidelity Investments together, both worked at Chart Room, which was just some awesome times and memories, and I learned so much there. We had this great chart. It was the periodic table of the elements. So it was, or
Yeah, that's
the
right.
periodic table of investment returns,
Yeah.
modeled after the periodic table of the elements, right? And it just showed you the sectors, top to bottom performance, and you could see the changes over time, right? So there's a lot of change within. So there's diversification, you know, You can kind of diversify with a number of different sectors, and you can kind of identify a lot of different alpha there, right, in the movement. I think one thing I would always kind of walk through to people and say, take a look at the top performing sectors. They might not always be there. Take a look at the bottom performing sectors. This might be a spot that might be worth taking a look at going forward. So, yeah, I think that being able to get a lot more insight through sectors, that identification of leadership and potential outperformance that you can target because it's a consistent framework really is, something that really tells you a lot more than just the S&P 500 or the Dow Jones, whatever it might be.
I think that's so well said. I'm glad you hit on the stability of the sector assignments. That's something I hadn't really thought about as much, Kevin. You're absolutely right. And certainly when you look at things like a value factor, in air quotes, growth factor, I mean, the names that are attributed to in momentum, right? I mean, there's huge switches with what's labeled what, depending on how things play out over a 6 to 12 month period. Sectors are relatively stable. I think that's a really good insight. I'm glad you focused there, Ben. I mean,
Thank
one
you.
of
Yeah, I
the
mean, it's just
you
one of
good.
those things too. It's just hard to keep track of a lot of stuff, right? It's just, I mean, unless you're doing it all day and you're like a professional, I mean, there's a lot out there, right? So I think it always is, it helps simplify your life. It's
We all need more things like that. I think
yeah.
investors as well. So I appreciate you highlighting that, Kevin. What I mean, one question is when we're thinking of the 11 S&P sectors. I mean, I guess one question is how much of a diversification or how much differentiation do we have at a time like this when it feels like this one theme AI is dominant, right? So it's almost like AI affecting a bunch of different sectors. Macro, events in the Middle East affecting obviously a lot of price and inflation and things like that. So in a period that feels as especially macro driven at times, how do we really think about sectors in terms of diversification when these themes are still sort of underlying a little bit of everything, I guess?
Yeah, totally right. Yeah, you definitely capture the mood, right, Dave? Right? Like, anytime you take a look at topic of just the popular media, yeah, I mean, whether it be Wall Street Journal or New York Times or anything, wherever you get it nowadays, it's like AI, AI, AI. It's almost like AI fatigue to a certain point, right? And I mean, with good, as you said, it's like that's a good point, right? It really is present in so many conversations, and that's why I think taking a look at data, especially things like correlations, help quite a bit.
Hmm.
Um, right now, this year, I think has just been so AI dominant. I had recently taken a look at correlations in the market. Now, the S&P 500, as of the end of July, had about a 0.87 correlation with technology. So it really very high. Like you really kind of say, when you're saying the market, you are kind of saying a lot of it's tech. So that, again, agrees with what you're saying. But at the same time, sectors within the market, other sectors, not everything is AI, even though sometimes it seems like that's the case. Correlation, there were, I believe there's 5 sectors that are negatively correlated with tech
Hmm.
at this point right now, or at the end of July. And those are kind of your classic staples, classic defensives like staples and healthcare, utilities, but also energy and real estate as well. So it
Hmm.
offers you, I mean, again, that's a negative correlation. There's certain degrees, but that's something that's, in the other direction, right? So just right there, by taking a look and being able to figure out, okay, which of these sectors do I want to be in? How much allocation do I want to give to these particular ones that are negatively correlated, right? You're able to diversify quite a bit just with that, right? And it doesn't require like, tremendous amounts of kind of work to do that. Like, you can just kind of figure it out. I think at the same time too, energy really is a big one, right?
Hmm.
That's kind of, and maybe that's kind of shifting towards like how to think about sectors too, right? There's obviously that tactical piece, right? Oh, this particular sector looks interesting. Let me add some exposure, take it off. I think there's a lot of value in just keeping a strategic position within a particular sector. And energy is a great example of that, right? This year, if you had bought the breakout at the beginning of the year in energy and just held it, would have been great, right? Top performing
Yeah.
sector through the end of July. And that's because, you got like so much geopolitical risk. You've got, the underlying oil commodity that like affects energy quite a bit. Just not figuring out the individual names, but just holding the sector would have given you so much value. Um, because again, that negative correlation that we've seen has been most extreme within energy, within not just tech, but with the market itself. And with this, currently as we speak, this situation in Iran is still going on. I'm not sure how long it will last. It might last some much more, it might not. But at the same time, like if you see that geopolitical risk and you want to kind of account for that, just holding energy as like a core position would be super helpful.
Kevin, I asked you about macro themes, and you told me about correlations just now. Are you suggesting we don't just blindly accept the narrative? We actually look at the data and see what that
It's it's a novel
surfaces?
idea, right? I
It's,
mean, yeah, it's right. It's groundbreaking stuff.
that's transformational. But to your point, Kevin, I think that's spot on, right? I mean, and I think that's a really really good way to think about it, right? Correlations are a really good way to illustrate technology for sure. Huge weight in the index, obviously an incredibly high correlation to like the Nasdaq, very tech heavy, but to the S&P as well. But there are a number of sectors that really are not as highly correlated, and in some cases very low correlation or even a negative correlation. And I think hitting on that is exactly right. I think that's a great way to think about some of those different sector bets. I'm curious. You had mentioned, this idea of sort of tactical versus more like of a position type of thing, and
Mhm.
I'd love if you could just expand on that a little bit in terms of how you would suggest investors and advisors listening and watching. How would you envision people using things like sector ETFs? I think a lot of people sort of automatically would say it seems like a tactical play.
Mhm.
Gold stocks are way beaten. The materials are beaten now. Maybe I jump into them. But tell me a little bit more about some of the maybe more structural opportunities, how that relate the tactical version, the short term versus the long term, I guess.
Yeah, totally. So yes, you're right. I do think there is that perception that sectors or sector ETFs in particular are more of a tactical vehicle. And of course, I mean, there's plenty of ways that you can play it tactically, right? I mean, one of the ones that I always kind of mention, for example, is just carving out a piece of your kind of core portfolio, and then tilting towards that kind of piece of the pie, just tilting towards a couple sectors that you think will be particularly good tactically, right? That makes both sides, core side. But I think that there's other ways to kind of think about it too. Like again, for example, the concentration risk of tech, 30 something or percent or so of the S&P. If you would take a little bit off of that and then allocate other sectors too, you really get quite a bit of diversification benefit, right? Just when you get those kind of volatile moves, and they'll come, right? That you'll be kind of positioned accordingly to help your portfolio. And then I think that there's also like ways, kind of like innovative ways to use sectors too, right? I think one of the ones that we've kind of focused on lately here at State Street is just income.
Mm.
Right now, like dividend yields within, for example, like the S&P 500 or even like the tech space, very, very low. You're not really getting that income. And we just actually celebrated a 1 year anniversary of our premium sector ETF. So these are the sectors, your XLK or XLY, whatever it might be, and they have an income component. So the idea is to be able to generate additional income to be able to kind of potentially make up, for example, for some of the areas that are just low dividend yielding, right? And that might particularly help someone, for example, that wants to be in the market, maybe like a little bit older, like a retiree, for example. Think about my mom and dad. It would be helpful for them to still be in the market. They still got, God willing, many more years left in them. But at the same time, like having that income, you know, they think it's a trade-off. Well, okay, like maybe there's a product that kind of helps with both, and something that might be kind of looking forward to. So yeah, we just actually had the premium income suite. I think it's kind of neat, and just celebrated the 1 year anniversary there.
Yeah, that's fantastic. And a lot of people actually probably may not be familiar with those, but I saw the whole ones like XLKI is the income
Hmm.
version of the XLK, and that whole suite is actually available. Thanks for highlighting that, by the way.
Certainly.
Really, really helpful, Kevin. Just to finish off here, and this has been awesome, and this is so cool to catch up with you, and I really appreciate you
Dang.
sharing some insights with everybody. Tell me this: when you look at the S&P, at the sector level, what sector relationship do you think best provides insights on overall risk appetite? And I would say, particularly in this kind of environment where things are pretty good, and the S&P is closing above 7,700 for the first time in history, all the bulls are getting all excited, rolling up their sleeves for the move to 10K or something. But what
Right.
would you be looking for at the sector level that would tell you maybe things are not as solid as they may appear?
Yeah, I think at this moment matters a lot too, right?
Mm,
Like there's that's something that's big. I mean, right now I think it really is, not to kind of harp on tech, but I think it is tech that has quite a bit that's a good tell of risk appetite, right? And just not only mention those correlations, right? But at the same time, it's just been last 10 years or so and even beyond, like it's just a high beta area. Makes a lot of sense. Semiconductors especially, they're so pivotal to this AI theme that's kind of omnipresent in our lives every day, whether we like it or not. And I do think that tech space really is a good barometer or a good indication of the amount of risk people like to take. But at the same time, like there are also kind of classical um, tells into like risk appetite. I think that are also helpful. Consumer discretionary is one, right? I always take a look at what's going on, at McDonald's, for example, or like the earnings that are going on in that space, right? It tells you a lot about the health of the consumer, and there's information there. I think too that, especially at the individual level, it just tells you a little bit about how much people want to take risks, depending upon who's working and who's not working, or whatever it might be. And then also financials too, right? I think
mm.
financials are quite helpful as well. That's an area that this summer has done pretty well and turned up quite a bit. Really kind of had to clear the wall of worry too at the beginning of the year, what with like credit card cap potential and the private credit kind of scare. I think it really kind of went through and it cleared that, but I think that financials are a good barometer as well. Just, financial conditions, these kind of classic things that you might learn in school, like in your economics class or something along those lines, makes a lot of sense. So I think of those three, all those three are cyclicals. And I think that's probably the common denominator, taking a look at those cyclical sectors. And when you take a look at them in total, you get a pretty good gauge of where the risk appetite is.
Kevin, you mentioned being former colleagues. I will never forget you coming in my office with a huge chart you'd created with sector relative performance as the main theme there. And I enjoyed our conversation that afternoon, and I am enjoying it today, seeing what insights you're able to share with us. So awesome to talk to you. Congrats on your successes. Congrats on the role at State Street. Thanks for what you're doing to educate and inform investors. I hope I can get you back on the show down the road to continue the
Oh, good. I
conversation.
mean, well, if only to Dave, and this is to bring this up, going back to your office. I remember the first time I went into your office, we were talking Ohio State football, and we just had the coaches poll come out, and Ohio State won, which is big stuff. So we'll have to check in down the road and hope that's still the case.
Kevin, depending on how the season starts, we'll see what timing we have to bring you back on the show. But I appreciate the suggestion. I'll keep that in mind. Listen, thanks for coming on today. We'll keep in touch, and thanks for being on the show.
Absolutely. Thanks for having me, Dave.
That was great fun, honestly, talking with Kevin again. And Kevin, thanks again for coming on the show. It's awesome to have you. Great to reconnect and talk about all things AI. And if you think about the beginning of the conversation, Kevin really digs into technology communication services. He's kind of immersed in this, AI ecosystem and how the stories have been evolving. And I thought he had some really good comments about, multiple timeframes, right? Thinking about the short term and the switches in momentum, but some of the long term opportunities and how they're related. He identified a couple individual areas where there's more weakness than elsewhere. Certainly software. We talked about the weakness in the software space and AI spending, of course, but particularly I love that comment about how software had sold off indiscriminately. And I think the way he described that really showed how someone like Kevin and really how we as investors can think about the technicals, think about the price action, think about the markets telling us in terms of investor sentiment and how that's shifting versus the fundamentals, right? Are these still good companies? Are the earnings and the opportunity for future earnings still there? Are the growth prospects still encouraging? And there will often be that mismatch where the fundamentals and the technicals tell you two different things. And I think recognizing the value of each of them and then quantitative, that third, important pillar that he described, I think thinking of the balance between them is very powerful. And as I mentioned to Kevin, and as I'll remind you again, what I always encourage people when you think about multiple factors, multiple disciplines as part of your overall investment approach, when you think of something like fundamental, technical, and quantitative, probably one or two of those you've got pretty well covered, right? Probably one or two of those, you're probably a little underweight or underexperienced or underexposed to the benefits of that particular methodology. And I would say find ways to benefit from the strengths you have, right? The area of your process that is well developed, but recognize that there are areas of your investment process that are a little underdeveloped. I would tell you that your investing journey is a journey. It's not a moment. It's not like, here's my process, now I'm done. My process continues to evolve 26 plus years into this game. And I hope wherever you're at in your investing trajectory that you continue to improve, you try to better yourself and make better decisions. And I think hopefully some of the comments Kevin made in terms of process kind of helps you. I love that quote, not getting swept up in the momentum of the moment. I think that's easier said than done, Kevin, but I really appreciate that point, and I think that is really well. I think that's really well put. Another thing he mentioned, I didn't get a chance to dig into it, but he said something along the lines of like, make the right decision. It's about making the right decision, but it's also about not making the wrong decision. And for me, having spent a lot of time thinking about investor behavior and decision making, I think that is a really important distinction to make, right? It's not about just being right. It's all about recognizing when you're wrong and admitting when you're wrong and avoiding those, bad habits and poor processes that can more easily get you to one of those bad decisions you're probably trying to avoid. Finally, I think really great insights. And again, what I was hoping to tease out of an expert like Kevin is really thinking about sector plays, sector rotation in a way that we hadn't thought about. I really hadn't thought about the stability of sector assignments, and I think that was a really interesting insight. And I think that's absolutely right. And also the correlations, right? Don't forget the benefits of thinking about how different assets are correlated, right? That's one of the things that often sort of drives me toward gold at some point in a portfolio allocation, because gold just tends to have a pretty low correlation and certainly more of an evolving correlation, a volatile correlation versus stocks, right? If you don't want your portfolio to just be the same equity bet, having low correlated assets with low correlated returns can be pretty powerful. And so I think thinking of sectors and some of the correlations as a way to differentiate, where am I getting something that's different than just an index, just the S&P, I thought was really a really good insight. Great take there from Kevin Abbott from State Street Investment Management. Thanks again, Kevin, for coming on the show. Good to see you again. We'll definitely look to have him back on for an update on the AI ecosystem as we continue to gather more info on that obviously market central theme. By the way, if you want to learn more about that technical pillar on your stool and certainly the behavioral pillar as well, those are the two where I tend to focus my time and attention, because I feel like the fundamental and the macroeconomic get widely covered and widely followed in traditional financial media. I feel most investors are exposed to the technical and the behavioral. That's what Market Misbehavior is here to help you do, and that's what our premium memberships are designed to help you actively improve in your own process. 3 great benefits to the premium membership. First off, we'll teach you all about technical analysis and behavioral finance through our virtual courses, which you'll have access to immediately. Second, we'll keep you informed and updated with our member-only reports, like our morning coffee routine, our weekly flight plan, and our monthly chart review. Finally, we will get you engaged and keep you accountable through our member community. You can ask questions, you can learn from other like-minded investors, and keep in close touch with me and my thoughts as we navigate these markets together. You can get access to all of those benefits immediately if you go to marketmisbehavior.com/premium. We'd love to see you as a premium member here today. That'll do it for today's episode of the Market Misbehavior podcast. Thanks so much for joining me. My name's Dave Keller, reminding you it's always a good time to own good charts. Take care, folks.